Hello, GovCons, and welcome back to the GovCon Funding Podcast. And today we're going to talk about the different products that banks and private credit provide to government contractors. You know, you may be out there realizing you just won a new contract, or maybe you're getting ready to bid on a new contract. You're going to need working capital, meaning you're going to need cash to pay for all those expenses, hiring employees. Maybe you need to buy equipment. And so now your question is, okay, well, what product is the right product for me? Should I get it from my bank or should I get it from a private credit source? And maybe you can't get it from your bank. They already told you there's no way they're going to give you that product. So you're going to have to go to private credit. All right, well, let's all go to our first topic today. And again, folks, you're joining us on episode 4 of the GovCon Funding Podcast. And just as before, let's just go through the disclaimers. This podcast is for educational purposes only and does not constitute financial advice for your specific business or personal endeavors. Gilman Bagley and the people appearing on the show are not liable for your results from the content we present in this episode. If you want specific recommendations, well, then contact us directly. See our contact information in the show notes or go to our website. All right. And while you're at our website, you might notice that we provide fast and flexible financing solutions to small businesses and lower middle market companies that allow them to access working capital by leveraging their business assets. And we've delivered over $500 million to our customers with fast approvals and same-day funding in some situations. And we've done all of that with over 100 years of private credit and business growth expertise. And of course, all of you by now should know our co-founder on the line today, Matt Gilman. Matt, welcome back to the show.
Thanks, Tony.
All right. Well, Matt, in the previous episodes, we started at a very high level, 30,000 feet, kind of looking at all the different types of capital that are out there available to government contractors. In episode 2, we kind of drilled down a little bit more, understanding the differences and the nuances and how fast and to what degree you could get products and how much they would cost on a relative basis. Then in the last episode, we really talked about the difference between banks and private credit. Well, today we're going to talk through the different types of products that banks and private credit provide. And it's important to understand that banks provide a lot of different products. And when we say products, we're talking about your checking account. We're talking about credit cards that the bank may provide to you. It could be wire transfers. All of those we're calling products. And that's what bankers will typically refer to them as well. Those are products that they sell to you as the government contractor business. But today we're going to focus specifically on those credit products that a bank may provide and private credit may provide. So let's start right here at the top of the list, Matt. We'll go with asset-based lending of credit. And this is generally abbreviated as ABL, asset-based line of credit. So Matt, can you kind of walk us through what is ABL and how does that function?
Yeah, absolutely. And when you mentioned before, right, you mentioned banks offer a lot of different products, and then, defining them a little bit further. It's important for business owners and of course, government contractors to know that these products are not unbankable products. Like, these products are not built for a market that isn't bankable. Banks offer asset-based lines of credit, and they offer contract lines. They offer invoice factoring. They just don't really offer it into the small business community. They offer it into the middle market community. So a lot of what private credit has done is said, okay, these are products that exist. They're products that are really good for small, medium-sized businesses. How do we provide that group of businesses with a product that larger companies use, right? So I think it's really important for everyone to understand that these structures are, they exist, and they exist in the bank. The question is, are you large enough to get those lines of credit from the bank? But back to the main point, right? So an asset-based line of credit. Generally, what you look at with an asset-based line of credit is looking towards the collateral first to provide liquidity for a business. Whereas in a term loan or a cash flow loan, you're looking at cash flow first for a repayment or for the underwriting of a loan. So an asset-based line, what you tend to look at in a business, every business, of course, has different types of assets. A manufacturing company generally will have plant machinery, equipment, raw materials, inventory, receivables. They have a whole lot of, they have a list of different assets that you can look at to provide liquidity against. And then when you move towards some of those service-based companies, which we know a lot of government contractors are, the main asset they tend to have is receivables. So an asset-based line is going to be a structure where a bank or non-bank lender is going to provide a business with a line of credit that's secured by the collateral of the business, and then the limits are going to be based on a formula. For example, generally a lot of lenders will provide 85% advance rate against your outstanding receivables. So if you got $1 million of receivables, you have about $850,000 to draw on your line. On your inventory, maybe it's 50% of your finished goods inventory at cost. So you got $1 million of inventory, you got $500,000 available on your line. So what you end up with is the ability to borrow against, again, inventory, plant machinery, equipment, and then of course receivables. The hard thing with an asset-based line is the assets that I just mentioned is a moving target, right? And I think that's what business owners have to understand is the receivables are changing every day. The inventory is moving, it's being sold, it's being produced, right? So that's a moving target. Whereas when you think about traditional real estate as an asset, it generally is the value. It doesn't move, it doesn't change, it's not being sold, right? Like it is an asset, it is there. So you can say, I got $1 million piece of property, here's $850,000 against my piece of real estate, and there's not much monitoring. With an asset-based line, you have to obviously monitoring from a bank or non-bank lender.
Okay, great. Well, let's talk about accounts receivable. There may be some folks who didn't study accounting at all, and maybe they're really good at what they do. They're a great service provider, but they're not a financial person, and they're not an accountant. Can you talk about what accounts receivable really is? I think a lot of people may know, but for some of those that don't, how do you define accounts receivable?
Yeah, I mean, accounts receivable is generally going to be you've delivered a service, you've produced the product, you've sold it to your customer, you've sent them an invoice, and now you're waiting to get paid. And that's an asset that that banks and non-bank lenders like because it's a short-term asset. You got net 30 terms with your customer, you ship the product, you're waiting roughly 30 days to get paid. So the money is always moving. But even though I say only 30 days to get paid, that manufacturing company could have spent, they had to buy raw materials, produce the product, package the product, ship the product. That 30-day net term might be 90 days or 120 days of cash outlay. So, that's why if you can accelerate on the receivable side, that could be a huge difference.
Yeah, you mentioned net 30, meaning that is the time that you have arranged with the receiver of whatever product or service that you're providing. That's the commitment on their end to pay you within 30 days. If you say net 30, that's the commitment on their part to pay in 30 days. Now, sometimes they may not pay you in 30 days, but that's the arrangement. And the verbiage is typically expressed as those are net 30 payment terms. And so your invoices, from a lender's perspective, we're always looking at the risk, right? What's that risk of us not being able to get paid back on that loan that we provided to you, the government contractor? So we're looking if asset, if accounts receivable is the primary asset that we're looking at, then, we're going to keep a close eye on, are you indeed getting paid in net 30? Or is it turning into 45 days and it's starting to get delayed, maybe 60 days? Okay, now that's a problem. Now we're going to start worrying, right, Matt?
Yeah, but I it's really important that when we talk about these products, especially with accounts receivable, that what we care about, right, what a lender cares about, and what a business owner cares about is the same exact thing, right? Like we're on the same team, and I think sometimes gets a little bit lost in conversation because what we do is we'll look at the credit quality, right, of our customer's customer, right? So, use us as a credit department. Sit there and say, okay, who am I selling to? Of course, the federal government or, a super large prime or large publicly traded company. It's very black and white that they should pay their bill. But what happens if this company and they do 300 million in revenue, you automatically assume that they're going to pay the bill. But we have access to reporting that might say, hey, their utilization's way up. Hey, like they're not paying on a lot of their trade time, their vendors. Or hey, the average they used to pay was 30 and now they're paying people in 48 days. So like we're on the same team as our customer. We want that bill to get paid. Our customer wants that bill to get paid. And as long as that happens, and as long as a customer realizes that we're all on the same team, it works great.
Yeah, yeah. We both have the same interest in mind. We both have the same goals. We want you getting paid just as right. If you don't get paid, we don't get paid. And I really like how you said that we're on the same team. We're not adversaries, and we'll probably talk about this in a future episode. But bankable behavior, and that's probably a trigger, is if somebody is not being forthright and they're just withholding information, or they're just timid about sharing information. That's probably could be a red flag, and it can be problematic in the relationship too. Look at us as your advisors in a lot of ways. We want to help you succeed. We have all of our best interests in mind to make sure that we ensure that you're a big success. And so I like how you indicate we're both mutually aligned, going in the same direction. We're all on the same team. All right, let's move on to two other products, and sometimes these get confused. But let's first talk about factoring and how that's different from a contract line of credit. So let's first talk about invoice factoring. And when folks think of private credit, sometimes they automatically say, oh, it's factoring, right? But there are nuances, there are slight differences. So it's important to understand what those two are. So Matt, can you give us a good sense of what is invoice factoring?
Sure. So when we talk about asset-based lending, and let's use accounts receivable as the main asset. Asset-based lending is going to be a loan, right, or a line of credit, a loan against your receivables. In fact, invoice factoring, technically what you're doing is you're selling your invoices for a discount. And the way that typically works is you might have an invoice for $10,000, and you want to advance money on it. And a factoring company would turn around and say, okay, we'll advance you money against your invoice for $10,000, and we're going to charge you a 1% fee. So for $100, you can get paid today or wait 30 days to get paid from your customer. And I think like with any products, with any industry, some products have a good name, some products have a bad name, but it all comes down to like who you're working with and what your experience is. Invoice factoring, similar to asset-based lending, if you remove the contractual difference of a loan versus a purchase, it's a great product. I mean, a service company, what are they going to have? A service company is going to have payroll. They're going to have heavy expenses on the payroll side. And they have to turn around and make payroll every 2 weeks, right? Or twice a month or once a week. And then they're going to bill their customer on net 30 or net 45-day terms. So invoice factoring it really is similar to a line of credit. It's just the formula at which you access money is going to be based on what you've billed your customer. And who goes into invoice factoring versus an asset-based line? You generally see that when you have more customer concentration, right? So you might have a small business where 70% of their revenue is coming from one place. So you set it up as an invoice factoring agreement. Whereas on an asset-based line or a contract line, you see they maybe have 10 or 20 or 30 different customers, and it's just easier for everyone to just set it up as a pool of receivables that somebody borrows against instead of individual specific ones.
Yeah, that's a really important distinction, especially for those that are just starting off in the government contractor space. You won your first contract, maybe you won your first subcontract, and it's a pretty sizable number of folks you're probably going to have to hire, or maybe some equipment you're going to have to buy as well. But when, again, we look at things from a risk perspective as a lender, all your eggs are in one basket. You have one customer. And so that's what we call concentration. And so lenders are always going to look at what's your concentration. Do you have all your eggs in one basket and that's where all your risk is? Okay. Or have you diversified your revenue streams? And you have, as Matt indicated, multiple customers, and everything's kind of, relatively even. You're not, one customer is at 80% and then the other 9 customers are the remaining 20%. So that's something that we're always looking at from a lender. Now, that doesn't mean if you have that high concentration and it's your first subcontract that you won't get the private credit. No, it just is a different type of product that it kind of moves toward. And so what you're saying, Matt, is in that situation where you did win your first contract, or maybe you even have 2, but maybe it's the same agency, something like that, probably that invoice factoring could be the right kind of product for you. We'll talk about the other product that could be right for you here in a second, but that invoice factoring could be the right product for them, right, Matt?
Yeah, it could be the right product. And I always say it's for B2B companies, it really is an optimal solution because there's no payments that anybody makes, right? A loan, you make monthly payments. A line of credit, you have an interest only payment every month. But with invoice factoring, there are no payments, right? We're waiting for the invoice to pay. So as a small business owner, you sit there and you say, okay, for a small fee, I can get my money today, and I don't have to make any payments until my invoice pays. So it is a pure acceleration of money that a business owner can get access to.
Yeah. And can you kind of explain these advance rates? We have them up here on the slide. Can you kind of explain how that concept works?
Yeah, the best comparison I can give anybody is you go to buy a house, right? And the home mortgage company requires you to put down 25% on your home, 20% on your home. So what they're doing is they're saying, you put in 20, I'm going to give you 80. And it's the same thing in factoring or asset-based lending. The reasons at which it exists, I can go into, right? But we say, okay, you got $100 invoice. I'm going to advance you 90 bucks against it. And when the invoice pays, I'm going to release the remaining reserve less a fee. Why is it there? Sometimes an invoice gets paid 95 cents on the dollar for some reason, right? Maybe it was billed wrong. Maybe some of the product was damaged, whatever it might be. So instead of advancing 100% less a fee and having to wait later to figure out how to get the money back from the short payment, we set up an advance rate. And then, as you look to the future, in some cases, what we do is we just increase it over time, right? Like, because especially in the government world, normally what you bill for is what you get paid.
Yeah. And I also like how you talked about the flow of the money, with an ABL, asset-based lending line of credit. You're paying the bank, you're making those payments. It's kind of like a credit card, right? You're paying the amount that you owe the bank each month. In this situation, in invoice factoring, it's kind of the other way around. It's the lender that's paying you, giving you the money up front because now they own that invoice. So they're paying you. And then, as you said, the advance rate could be 80%, 90% right up front. They'll give you. And then when they get the invoice payment, then they're going to pay off the rest to you, and they're going to hold back, whatever their fee is, maybe 1%. What is kind of the average fee, Matt, that an invoice factoring company will charge?
Yeah, a lot of it depends on how long an invoice, is projected to be out for, but it could be like anywhere between a 1 to a 3% discount on an invoice. And
Okay, so they're
it's
gonna
always that
hold
question.
1 to 3% on that. And
Yeah,
is it?
and it's always one of those questions too, where and sometimes I enjoy the longer conversations around uh, the product and the benefit and some of the questions that business owners have. One of them is, to be clear, if there's a 90% advance rate, that's not a 10% fee, right? That's just a reserve that then later gets released. Sometimes you talk to a business owner who says a 2% or 3% fee on an invoice. I'm not doing that, right? It's the cost is just too high. But you turn around and say, well, if your customer said, I can pay you right now if you give me a 2% discount, would you do it? And almost every time people are like, yeah, I would do it. Right.
Yeah, right.
They might say I wouldn't do it every time. Right. But I would do it when I need it or I want it. And that's the same exact concept. Right. All of these are about options and about having access to capital for when you need it. It doesn't mean you always have to use it. And as we all know, the best people, the best business owners are planning ahead and applying for money when they don't need it and talking to the banks or the non-banks when they don't need it to make sure that they're set up with the right product for when something is needed. And look, a 3-day gap in an invoice payment can be the difference between making and not making payroll. So how are you going to solve for it? It could be a line of credit from the bank. It could be invoice factoring, right? It could be you have cash reserves in an account that you can borrow against, but it's got to be something, because if you don't have something, then you start scrambling and then you start applying online for loans or something that, right, is going to have a negative future impact on the business or cost you a ton of money.
Yeah. It could be ABL, line of credit. It could be invoice factoring, and it could also be a contract line of credit. So let's talk about this third product, Matt. And sometimes folks kind of confuse it with invoice factoring. There are some subtle differences. Can you kind of explain how a contract line of credit may be different, say, from factoring?
Yeah, so a contract line is something that, is really something that we as a company offer, right? Which has multiple products within it, depending on whether or not that company needs it. And we'll do a whole conversation on another podcast about all those other products. But because we are an expert in providing capital to the government contracting community and to B2B customers, we understand the business and we understand where the pain points come from. So what we have is we've set up a contract line of credit to solve for those pain points, which, again, there's multiple products within it. One of those is a mobilization advance, right? So you have a contract, you're getting ready to get it started. Maybe you have to get people out to a site. You got to buy laptops, computers. Maybe it takes some extra money, but you don't have that cash. But we know you're going to bill for it in the next cycle, or it's going to be divisible over the next 12 invoices. So we'd look at that and say, okay, we're going to provide an advance for mobilization. And then someone starts working on a contract. And, if they were tight on mobilization, they're going to be pretty tight on payroll, right? So now you've got this next cycle that comes up, which is we've got people there, they're working, but I can't bill for it yet. How do I solve that? So within a contract line, we provide an earned but unbilled advance, which really is what we call payroll funding. So we'll fund the payroll on, the contract starts on January 1st. We help mobilize. The first payroll is on January 15th or January 23rd. We'll fund it. And then it gets billed to the government or to their customer on February 1st, 2nd, 3rd, 4th, whatever it is. And now we'll advance against the receivables. So the reason that we have this contract line is to solve for the pain points along the way that we know like a GovCon is going to face. And then as what we find is as the contract is being performed on, profits are starting to catch up, and maybe somebody doesn't need to advance as much for payroll. And towards the end of the base year, they're not even advancing for payroll. They're only advancing for invoices. And then maybe in the second or third year, they're not even advancing any money on this contract anymore, but they've won 3 more, right? So they're advancing and we're helping them with other contracts. So a contract line, like the short answer is it's a revolving line, but it's built to be able to solve the challenges that we know government contractors face.
Yeah, it's that revolving line. You'll hear that word. We'll probably go into more detail, but you'll sometimes hear the word revolver when you're talking line of credit. But it's that revolving concept, which means it's kind of ongoing in specific relationship to that one contract that you have. So it's a closer partnership, I would say, with the customer, between the private credit source and the individual government contractor. And this is probably one of those things that you most likely will not have a bank willing to do, right, Matt? And this is where, as government contracting experts, we understand how government contracts work. We understand what you're going through operationally, business development wise. And I really want to emphasize, Matt, what you said. Always reach out to us early. Don't reach out to us at the last minute. That's when you have real problems that could surface, because then you're not in a position where you could potentially negotiate. You're kind of putting the lender at a disadvantage as well. So it can be problematic. And Matt, let's finish up with the last piece here. And folks, I know you're probably wanting to hear more about the contract line of credit. There's a lot more we can talk about there. We'll do that in future episodes. As Matt indicated, there are a lot of products within that we can really get into, but we wanted to address these key products of asset-based line of credit, the invoice factoring, and then finally the contract line of credit. But Matt, there's one other item here on the screen, and it's called financial support letters. And let's just close out real quickly talking about that. And I think it's really important for people to understand that, having a financial support letter, and when we would be able to provide that to them.
Yeah, it actually piggybacks on the whole planning discussion, right? So, what we'll do for our customers is provide financial support letters to put in with some of their bids, to basically show that they do have a line of credit and they do have not only the expertise to perform, but also the financial capability to do so. So we'll provide financial support letters for existing customers of ours. And what that also does is it helps eliminate the question that people often ask themselves is, what if I win? They've got 30 proposals out there, 5 proposals out there. They're projecting to have a win rate of a certain, whatever it is, 2. And then they end up with 6 and they say, I can't, if I win everything I've got, I don't know how I'm going to support this. And if we go through the financial support letter setup, they know what we can fund. They know what we can support, so that when they win, they're not scrambling and saying, oh my God, this is great. I have opportunity, but how am I going to pay these 40 people?
Yeah, you may be, as the government contractor listening to this, thinking, oh, how am I going to pay for all these people I need to hire and equipment I need to buy? You know who may also be asking that question? The government. The government customer may be asking, how are you going to pay for all those people and equipment you need to bring on board to successfully execute on this contract? And folks, the government contracting officer, that's their big consideration. And the source selection boards, they're looking at your proposal and they're evaluating you based on your risk. Just like we as a lender are looking at you based on risk, they are looking at you as well. And so they may even make it a requirement in the solicitation that you provide a financial support letter. Sometimes they call it a financial feasibility letter, where they ask for your lender to indicate to them in a letter, as Matt just described, in your bid, so that you can prove that you are financially feasible and you can actually execute on that contract. So we'll probably jump into more detail on those financial support letters too, Matt, because there are different ways that lenders can word those, and it can be a little tricky. Maybe we'll bring on a former contracting officer to walk through it with us too, to see how they talk and consider these financial support letters. So, okay, folks, we covered a lot today. We talked about the different products that banks and private credit providers deliver to their customers. And we also talked about the financial support letters. Next week, we'll dive into even more detail. And Matt, thanks for joining me today. And everyone listening, we'll see you on the next one.